Hello and welcome to your Monday Futures Market Outlook for June 7th, 2010. This is Patrick Srezna. For those of you that have not had an opportunity to try out eminisource.com, 30-day complimentary memberships are available, no credit card required. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles that the market has gone through. Many months ago, we actually crossed above that, giving a bullish signal, but we were suggesting all along that at some stage we would need to see a profit-taking cycle to solidify the bullish breakout. Really, at this juncture, the scenario which we're looking for and we do favor is the fact that we have a market pullback that finds important support, maybe as low as the 950 or 900 area on the downside of the S&P over the next several months going into the summer, but subsequently finds a good basing from there and actually makes a bullish move to maintain that bullish signal that was given several months ago. But in the same regards, we do need to address one major scenario that we cannot rule out at this point, is that the entire rally that we've had up until this point was nothing but a big retracement in the bear market. If in fact this was nothing but a retracement higher, a secondary move for a primary bear market, then any technical breakdown, especially below the 950,000 level on the downside, could open the window for retesting all the way back down to the bear market lows. So at this juncture, again, we do not favor this scenario, but we certainly cannot technically rule it out. When we take a closer look at that S&P 500 using that E-mini futures contract, we were looking for a retracement higher that could go even as high as the 1140 area, but we have completed it on a shortened move down towards that 1110 area on the downside. Subsequently, the market has already rolled over and is now testing right into that 1040 to 1050 focal point on the downside. This is a very critical moment for the marketplace because if these support lines must absolutely hold for the bulls to have any chance of still making a deeper retracement higher. If we have any technical breakdowns below this level, there is some support lines on this flag that suggests we could take a pause at the 1020 area, but really all of the technical downside targets measure as low as the 960 to 1000 level on the S&P. So this is going to be a critical moment. If we see that these support lines hold over the next few days, we can't rule out another bounce higher, but anything that breaks down below would create some more accelerated selling to the downside. So again, just to quickly review our key points, our thesis since January 2008 continues to be that we're in a secular bear market, and we will not change that thesis until we see the extent of that sell-off that we're currently in. So if this sell cycle again finds major supports in that 950,000 level on the downside, and we see good basing there over the summer, subsequently we would change our thesis to a more bullish one. But at this stage, because we cannot rule out the fact that this market can break right down, we're going to maintain our thesis. The length and the duration of this past retracement was very weak, which increases the likelihood of deeper selling. It's important to stay conservative in your investment portfolios, and any investors that are or traders that are trapped in any long positions could consider any variation of a number of collar strategies to hedge out some of that downside risk, as the protected puts are relatively expensive, and therefore you wanting to offset some of the costs on the upside would be prudent. Next here, I want to take a look at the NASDAQ 100 E-mini futures contracts, and the little push higher actually retraced deeper than the S&P did, and so it shows a little bit of relative strength in the technology sectors, but nonetheless, there's going to be further selling here if the S&P rolls over. So we had now a breakdown off of that 1880 to 1900 focal point on the upside, and we marked off where the shortened measured moves measure all the way down as low of retesting around the 715 to 750 area on the downside, which we could see if the S&P gives out on the bottom side. In the same regards, if we have a full extended sell-off, targets can go even as low as the 1600 level on the downside for where selling in the Nasdaq could go. Next here, I want to take a look at the US dollar index futures, and more or less last week we were talking about that any technical break above the 87.50 highs would immediately open the window for a move that would come up into about this 88.5 to 90 area on the upside. We've now completed the shorter targets, and there are definitely some upside targets as $1 or more higher here. So we're going to continue to watch if the dollar index can maintain its strength to the upside targets. The one thing we do want to emphasize is that this is mostly being driven by euro weakness, and if there were, for whatever reason, there was a catalyst for the euro to have an extended move lower, then the dollar index will actually potentially break above the 90 level, even up to the 91, 92 area. But technically, our measured move is only targeting this 90 level for our technically trading methods that we're going to focus on. Next here, I want to take a look at the gold futures contracts, and we were suggesting last week that any technical breakouts above the 1210 to 1220 area on the upside would immediately open the window for a move not only back up to this 1245 to 1255 focal point on the upside where we're right now trading, but would actually have a potential move that could go even as high as the 1275 to 1300 level on the upside. That would actually be confirmed if in fact we have a solid closing above this upside target. So we're going to be watching whether or not gold can base here and actually make that technical breakout on the upside. Next here, I want to take a look at the E-mini crude oil futures contract, and again, we were looking for at some point a bounce in crude oil, and it's fulfilled some of the basic upside targets we had, but very little to no follow through at 75, 76 focal point is now is a formidable overhead resistance. This is now a flagging formation that is technically starting to weaken on the downside. It's bouncing off a very critical 68.70 support line, which is a must hold for any crude oil bulls. If that level on the downside is broken, immediately opens the window for another accelerated move on the downside, and this would definitely happen if we had an extended euro breakdown as well as a US dollar index rally. First downside target could go as deep as the 60 to 63 area, but even bigger picture targets could even go as low as the 56 to 58. Now again, we are not targeting those until we have very distinct evidence that crude oil has broken below the 68 to 70 level on the downside. Next here, I want to take a look at the 10-year Treasury notes, and we more or less saw that support come perfectly in right in our retracement box, right in that 118.5 to 119 area at this juncture, with these support lines having held and a beautiful breakout candle on the upside. We are looking for continued strength in the 10-year Treasury note, especially if we have continued weakness in the euro and strength in the US dollar. If the first targets on the upside up to the 122 to 122.5 area, but any technical breakout above there could see us even as high as the 125 area on the upside. So first we're looking for that overhead resistance though. That was your Monday Futures Market Outlook. Thank you for joining me.